All right, guys, as promised, here is our first um, investment package review. So this is, I did take a brief look at it prior just to kind of skim through it and see what was there. But I'll be going kind of deep dive into it. Trying not to spend too much time to going through it. Really kind of focusing on it from a passive investor's perspective, not really providing any kind of guidance for other syndicators on how to do or not do a deal. It's really just from a passive investor's perspective because there are certain things that they just don't have access to, and trying to give them some guidance on things to look for, and some calculations that they can do for themselves, and at least set some kind of benchmarks so they know things that are reasonable, things that are unreasonable expectations with the deal. So without further ado, let's go ahead and jump into this one. Now the camera is going to stay mostly on me, at least while we're getting into it, just because, confidentiality, and we don't want to upset anybody's feelings here or brag about anybody either. So we're not trying to market or discredit anybody, just trying to keep this purely educational. So this deal, it's a 194 unit deal. It's in Georgia, and very nice package, by the way. Let's see, moving, so they're listing it as the #1 moving destination. I'm not sure about that. Most affordable big city, and then #2 metro for economic growth and potential. Very cool, big statements. Let's see what we got here on the next page. It's over 50 pages long. Oof, it's a lot to get through. So we'll do our best. First, second page, normal disclaimer, table of contents, executive summary. So let me put some of this on the board. All right. So we've got equity multiple 1.9. We've got 15.6 IRR. Average cash on cash, 8.5. And then average annual return, that's stupid. So I see this more and more. People putting this average annual return on there. It's just this divided by however long you're holding it. So here they're putting 18%, average annual return, which they're also showing you got 1.9 equity multiples. So 1.9 minus your original 100 gives you 0.9 divided by, this is a 5-year hold, which equals 18%. So they're the same thing, they just listed it twice. It helps fill white space, but mathematically it's kind of a waste. Cap rate 5%. Let's see, percent cap. Reversion cap rate 5.6. I like that. I like that they're expanding. That's always good. I think you really want to look for that more and more these days. If you see deals where they're banking on going in at a high cap rate and exiting at a lower one, you really got to question that. Pref 8%, it's nice, standard. GP/LP split 70-30, so we got 70-30 split. A bit on the high side, but nothing too crazy. I'd be curious to see what exactly that is, if it's a IRR hurdle or just carried interest. It looks like it's a carried interest, which actually is a bit high for carried interest. Actually really high. Hold time 5 years. 5 years. Sorry, my writing's not the best. DSCR 1.4, it's good coverage. Units 194. We got built in 88. YOC is year of construction. Purchase price, so they got it for $23,800. Purchase price. And rehab budget, which is 1.3. Rehab, which, let me do the quick math on that. I like to see what that is per unit, because that's typically how I would understand things. So 1.3 over 194 gives you 6.7 thousand per door. Not bad. I mean, it's kind of a, depending on the breakdown, how much is interior, how much is exterior, because that's another thing to keep in mind. A portion of this is going to be interior and a portion will be exterior. So, you know, if I'm guessing there's only about 4,000 interior. We'll see in the details, but let's really see what their projections are for rent increase. So other costs, 2.2 million. I guess that's their sources and uses. Put this on silent. And total cap, 27 million. 2. Sources and uses. Let's just put it closing. Total cap, 27.3. All right. And then at the bottom here, let's see, we've got projected returns on a 100K investment. Again, I think that's a bit silly to put that, just because if you're sophisticated enough to invest in these deals, you're sophisticated enough to multiply the annual return by whatever your investment is. But you know, it's good for optics. It certainly looks good on these packages and helps fill space. So looks like year 1 through 5. Let's go and lay these out. Got your first red flag for you. Switch back to the camera and see what you guys can. Okay, so get down here. Here's your years, 1, 2, 5, and then their return. 8%, 8%, 9.3, 8.4. And then 158. Okay. Investment highlights. Let's see. Current owner spent 500K on rehab, partial upgrading units. Got it. And then repositioning, reband, and revitalize. Sponsor will bring from Class B to B+. In line with desirable submarket location. Will rebrand immediately with 1.3 rehab. Expand upon a proven value-add program by implementing curb appeal enhancements and strategic interior renovations. So the only way that it's a proven value-add program is if the previous owner had already renovated a couple of the units and you're then continuing that renovation and you have a rent roll that shows that they are actually getting that rent premium. Otherwise, it's just words. 200 rent increase potential. That's a lot. Let's see. So you're going to spend. So they're spending 1.3. They're saying they're going to get a $200 rent increase. So $200 times 194 units times 12 months. So you're going to get. Let's see. Rent will be 466,000. And you're going to spend 1.3 million. So you're getting 36% return per year on your original investment. We'll see. We will see. It just seems a bit, typically when we do these, when we get $200 rent increases, you're doing a much bigger rehab than 67,000 per door, 6,700 per door. Typically, we're doing one that's $37,000 per door. We're getting a $450 increase in rent. Typically, I did one on 137 units that was in a great location, Houston. We got a $120 rent increase on a 7,000 per door rehab. So about half. Now, this one may very well just be in a great location, but then again, it makes you question why hasn't the previous owner done it then. I also have to assume, I think it's good to assume that most owners are not stupid and that they can do things for themselves. So unless there's a really good reason why they're not doing that rehab or doing some portion of it, I would always be skeptical about that kind of stuff. Let's see, it's another page, give you the unit mix, that's good. It looks like a nice ratio of 1s, 2s, and 3s, large units, that's a good thing. Put that on there. Average square foot. And yep, so now we're looking at the metro, giving stats on that. Okay, how close are we to Atlanta? I'm not sure what we're talking about. This one was in Fayetteville. Let me check how close we are. There should be a map on here somewhere. It shows, it's talking about the airport, which is cool, really digging into the metro. I mean, I think they got a lot of macro highlights, big picture highlights for the city. In my experience, real estate's still rather local, rather micro. So you can show all the amazing stats you want. But I imagine even in your hometown, wherever you are, there's going to be great locations to be in and bad locations to be in. And no matter how good or bad your city might be, there's still going to be areas that are great or worse than others. So while you can certainly paint a story and a picture around an economy, when it comes to real estate, you still need to really focus. I would focus on the 3-mile radius. You start getting outside of 3, 4, and 5 miles, and you're looking at stuff that's 30-minute drive away. In my opinion, it's just wasted time. I mean, you're not really you're not showing much. It's good to be outside of a big city. So I'm finally looking at a map here. It looks like that is about 20 miles outside of Atlanta, which, I mean, it's good. It's good. I mean, we got cities that, we have tertiary markets outside of Houston that do very well. But again, you got to be careful. You don't focus on Houston so much. So in this case, I wouldn't focus so much on Atlanta. I would focus on that the micro. So here, more stats in Atlanta, more stats in Atlanta. Don't care. You own other properties in Atlanta. That's nice. How close are you to this one? They're not that close. It looks like one is about an hour away, 45-minute drive away as the closest. And you got another one that's, what you try and show when you own properties in the same market. So we have 10 properties, all basically in Houston. Three are in corporates. But the benefit is when they're close, like within 3-5 miles of each other, you're able to have a lot of synergies there. Otherwise, just having a lot of properties in Houston or this guy having properties in Atlanta, I mean, it's nice, but it shows at that market, but there's no value, there's no additional synergy there unless they're closer together. So now we're starting to get into some of the micro, talk about restaurants. It's always good. But what I'm really looking for now going through here is, where are your comps? Where are the other properties around you? Still not seeing it. Now we're talking, now they're showing me drive times. That's major employment. It's great, but your best bet when you're looking at these is you want to see the competition. Okay, we've done 3 more slides, and now we're talking demand drivers. So let's see. Rent is expected to grow more than 17% over the next 5 years. Okay. So 17% over 5 is 3.4%. Congratulations, your average. Limited supply in the market. Okay, within a 3-mile radius, there's only been 2 other properties built in the last 10 years. So either everything around you is old, which is fine, or there's not that strong of a market because nobody's building there in the last 10 years. So you just showed me a bunch of slides about how great this market is, and yet nobody's building, at least nobody's built there in the last 10 years. So which is it? All right, so now finally, okay, we are just past page 20, and now we're getting into the property details. Cool. Let's see, we got 405 parking spots, 2.09 per unit parking ratio, which is good. Typically, you want to be, if you're above 1.65, at least in the Houston market, that's tight for us. So we look for stuff that's over 1.65. Here, they're at over 2. So I would look at either this or me. I would look at actually demolishing some of the parking, converting some of it to covered parking that you can charge for. But yeah, that's a lot. So you've got an opportunity there to make some money on that. I'm not sure if that's one of their upsides. Stories, you got 2- and 3-story splits. Built in 88. 88 was a good year. Stuff, in the 70s and early 80s. Has a lot more galvanized piping. This one probably, let's see, it has galvanized piping. Plumbing. PVC. So this one's PVC. PVC is good. I mean, it's not, it's better than Galveston for sure. Galveston is going to have tons of leaks. PVC just, I think the issue there is it gets brittle. But I would much rather have a PVC pipe property over a galvanized. So no complaints there. So that's great. HVAC, forced air systems. It's funny how HVAC changes depending on where you are in the country. So we've got different HVAC because we're in Houston. I know I've got family up in New Mexico, and their HVAC is basically it just circulates humidified air. They're just anyway. Doesn't make any difference to what we're talking about now, but I noticed on here their HVAC is a bit different. Individually forced air systems. Plumbing, let's talk about that. Units are served by gas and electricity, or individually metered. That's nice. The problem with gas, just so you guys know, from an operation perspective, when you move out of a unit, you've got to, they turn off the gas, and if the unit's been vacant for too long, you got to get them to come out and retest it, and recertify that unit every time. So it gets to be a pain in the butt. But it's an area that a lot of people like, so we just kind of plan for that. Ceilings, 8-foot ceilings, kitchens, laminate wood, cabinets, laminate wood cabinets, laminate faux granite counters, refrigerator, ice maker, gas range, oven, overhead vent hood, microwave oven, dishwasher, double bowl stainless steel sink with disposal. Not really matters too much. Here, show me a site map. Looks like they have lots of green space, which is nice. A couple of parks, pool, trash, laundry and gym, mail office. They've got bocce courts. That's cool. Basic gym with some treadmill, playground. Playgrounds are nice. We actually remove. We've when I first started, people were adding playgrounds to every property, and now we're getting to the point where we're removing playgrounds because we either need the space for something else or they're just not being used, and we can landscape it better. So, the generation's changing, and kids don't. At least in Houston, people don't go out as much because it's so freaking hot out here. Nice pool area, looks pretty basic, just a basic pool. Now we're showing interiors. So we've got Formica counters, which has some sort of marble color to it. It's not resurfaced, which is good. I hate resurfacing, and I think it's the worst. When people talk about resurfacing, the problem with resurfacing is that when you do it, it looks nice for the first unit, and then after that, every time the unit turns, you're redoing it. So you've saved money up front. It's about a fourth of the cost up front to resurface a counter instead of replacing it. But then you're resurfacing it every time they turn. So over a 4-year period, you could have just replaced the counter. Plus it just looks, it doesn't look as good as a Formica counter. A Formica counter, a new one, you'll be able to get a couple of years out of it. So for us, we no longer as a policy do resurfacing. But anyway, new counters, which is good. Sinks, black appliances, gas. You got dark cabinets and vinyl plank flooring. Good stuff. Living rooms, basic. I bet you I could show. I'm sure there's nothing. No, we'll keep it simple for now. Maybe in the future I might show stuff, but yeah, unit mixes, we went over that already. Let's see, interior storage closets and some, laundry utility closet and some. Okay, property tour video, it's nice. So we are now at page 30. Still haven't really discussed anything we're doing on the property yet. Okay, now we're finally actually about to discuss business plan. So apparently they're an experienced sponsor team. They have a decade of combined institutional experience, which is great. I've got a decade by myself. With their unique data, analytic skills, implementation of the firm's asset management playbook. So they're really banking on their 10 years and their analytical skills to, grow rent. I'm sure they'll have to tell that to the renters. We will capitalize on the team's deep knowledge of the submarkets of force appreciation. Okay, say so. Management experience. So they're doing valet trash, payroll, pest control. Okay, no, I'm not seeing anything groundbreaking here. Interior renovations, here we go. So management team, project, management team, the management team, project, some sort of typo there. An interior CapEx per unit of 5,100. So that's why I said there. So the 6,700 total, 5,100 is going to be on the interior per unit, resulting in underwritten rent premiums of $136 per unit. Okay, so where's the other 200? Okay, so 136 is more reasonable. Good. Okay, I still like to see some comps, but okay. New floors, washer and dryer installation. It's a big one, actually. We do that in a lot of properties. It's expensive, but it's almost guaranteed upside because people will pay for it. Light fixtures, kitchen cabinets. The property must go through a cleansing phase before the potential is realized. Management team will strengthen the leasing criteria and remove non-compliant tenants. Gradual process and will result in an interim disruption in occupancy. Target results are a strong, stable tenant base within a well-performing asset. So they're talking about how the first couple of years are going to be turbulent, but they're still going to somehow hit an 8% cash on cash in years 1 and 2. So something's not mixing there. Exterior CapEx. You're going to spend $500K on the exterior. Common area improvements listed below. Let's see, landscaping, fitness center, dog park, exterior paint, summer kitchen, that's an outdoor kitchen, in Amazon lockers. Amazon lockers are a good ad. Landscaping's nice. I guess they're updating the fitness center. Dog parks are a must these days. People love their pets. And now they're showing a renovated unit. I guess the same cabinet. Let me go back. Yeah, it looks to be the same. We will create a modern and consistent looking feature, vinyl plank flooring, new faux stainless. So they're switching to stainless appliances. So they're saying painted cabinets, which is resurfacing cabinets with new hardware. That's okay. Just know that you're going to be, it increases your maintenance cost. So hopefully they updated their maintenance cost because they had unpainted cabinets. They had regular, nice, pretty cabinets, and now they're painting their cabinets, which has a tendency to peel and stick and whatnot. So every time that they turn a unit, they're going to be doing either touch-ups or resurfacing. And also, if not done well, it can actually make the property look worse. So the first coat tends to do well, but over time, over a couple of turns, it'll not age as well. They're putting granite counters in. Okay, so again, if you're going to put granite, which is, we're a big fan of granite, but then why do the painted cabinets? Just do new cabinets or new fronts. New fronts are an easy option. New light fixtures and plumbing. Those are up. Modern two-tone paint job, crown molding. New vanity in bathrooms, upgraded lighting, tile backsplash. Very cool. So that's the renovated unit. Those are all the things they're doing. The standard unit description. Okay, I see here. So the standard unit has, those are what has. It looks like the standard unit. They redid the fronts. This guy. So this guy the previous owner redid the fronts, and you've got a brown box with a white cabinet front. So, I go back on what I said. They're definitely better than, I guess I'm confused. This previous picture they showed, maybe that was a fully renovated unit, or maybe that's the painted. I don't know. It doesn't seem to look like what they just showed in the classic. But anyway, if their classic is all white with brown boxes, then yes, you need to paint those. And they seem to be quality boxes, which is great. I described the rest, but they are ugly. All right, so increase to rent. There we go, market comps. So we've got 5 properties here. And the subject property is the 6th. And there's 2 ways you got to look at this, right? You got to look at it both as the kind of price per pound, price per unit, and you also got to look at the price per square foot, because renters, when they're looking at a unit, they're not always looking at price per square foot. They're looking at a 1-bedroom is $800 versus that 1-bedroom that's $750. It might be a little bit different price per square foot, but that's not how they're doing their budgeting. It's based on price per unit as a renter. So you got to be aware of both. So anyway, looks like, so average rents, $1,100, $1,185, $1,500, $1,300, $980, and this subject property is at $1,000. So yeah, I would say that looks like a little bit of upside there if these are all renovated. Yeah, I can definitely see. So their projected rent increase is 177, which would take it up to 1181, which would put them just behind. That put them basically as the 4th in line. So let's see if they have any other information on these comps. So they're going from, so they're at $1, basically $1 per square foot. And the average for that market is $1.23. And then you also, so I'm looking right now at the square footage, the average size of the units, which is also important. So you really got to kind of factor all this in. So the top 3 guys, or top 3 properties, are over 1,000 per unit square foot. Those are huge properties. So you got one's 1,070, 1,073, 1,121, and 966. Was this one above? So they've got a comp on here. So that's just sloppy. So they've got a comp on here that wasn't on the previous slide. So it's just not consistent. So they probably shouldn't have shown that. Anyway, so now let me figure out which one. But it actually helps him because this one, oh, well, no, because that one was built in 2017. So one of the issues you'll run into, so just be aware, so new properties, when you're comparing old versus new, and one of the big differences, even if you're the same square footage and you copy all the amenities exactly, and the finishes, et cetera, the only thing that you'll never be able to replicate on an old property versus a new one is the ceiling height. You can get creative and you can possibly rip out the ceiling to give it more of an industrial look. But new properties have 9, 10-foot ceilings. This one I spread earlier has an 8-foot ceiling. And so you're just stuck with that. It's not a deal killer by any means. I'm just saying be aware of it. So you're not going to be able to directly compete with a new property. So if the new properties are all of your comps, which this one isn't, he's got a good mix of ages. So average age is 96. This one was built in 88. So you do have some older, some newer properties. So earlier, I don't know if you remember in the package, he said they haven't built anything new in the last 10 years. This one was built in 2017, which was 3 years ago. So, and there's another one here built in 2005. So maybe they just forgot about the Meridian. Or who knows, maybe it's not supposed to be there. Maybe their radius was too big. But anyway, that's an obvious oopsie. I'm not seeing anything here on their comparables, ignoring the 2017 construction property. We don't want to ignore it completely because that one has $1.53 per rent per square foot. So that's kind of your ceiling. You're not really going to go much higher above that, or you're not going to go above that period. And you've got some older product here. This one's one that was built in 86. It's at $1.40. And their rents are almost $1,500 a month. So it looks like there is some upward mobility. You can, it's 2 years older and it's getting tons of rent. So yeah, I'd be curious to see where the locations are. Because that's also important. You've really got to see, which I haven't seen a map yet, but you got to be very, and I see this a lot on our end with brokers. They'll send you these rent comps. Every time you get an offering memorandum from a broker, they put these rent comps in here, and typically we pull our own rent comps. We have our third-party marketing service that we use because what we find is that rent comps we get from brokers and others tend to be the best, the most favorable rent comps you can find, which, for us, we're not looking to have the most favorable, we're looking at the most accurate. So I'd be curious to see on a map where these properties were. Hopefully none of these properties were actually located in Atlanta, and they're actually within 2, maximum 3 miles of the property. So you get to see a rent comp map. Talking about management, he's listed 3 numbers here, 130, 19, and 500, with no description of what those numbers mean. Okay. Efficiency. Okay. Why we like this property: limited supply in the market, strong rent growth 6%, median income 70, rent upside 250. So I don't know. So he's saying 250 here. Earlier he said 177, and on the first page he said 200 as the rent upside. So again, consistency is key. It just gets to be confusing if you're not consistent throughout your package. So now I don't know what you're saying the true rent upside is. I'm going to assume that it's well, I don't know. Here on the actual rent comp page, you're saying 177 increase. But then when we did the value add page, I want to say it showed $136. Yeah, so now on this business plan page, you're saying interior renovations will add rent premiums of 136. So it's just not very clear where all the money is coming from, the numbers. There we go. So we're showing projected investor returns, which I have listed back here. And again, he shows that same stupid average annual return number. Financial highlights, skin in the game. They're putting in 300K, which, let's see how much they're raising. Total equity is basically 7 million. So they're putting in just over 4%. It's not bad. I mean, yeah, for a big enough deal, you try to stay 3 to 5% typically where we're at on our deals, going as high as 10%. But ideally, if you want to be above, between 5 to 10 is ideal when you're doing these deals. I'd say 3 is the lowest you'd want to see a sponsor in a deal at. Loan DCR, 80% LTV. Okay. Loan to cost. DSCR, 1.8 year 1, 1.6 in year 2. Loan rates. If you're getting a bridge loan, 4.8% over 3 years. Increase of 0.15% for 2 additional years. Not bad. It's not great. Project size and timing. So, yep, 5-year hold, went over all that. Investment offering. So here's where they kind of talk about the details they're offering. 506C, 2% acquisition fee, 2% management fee. Okay. 8% pref return, 70-30 split between LP GP. Goes up to 50-50 if projected returns are over 20% average annual return. If the overall project returns are above 20% average annualized return, only the amount over the 20% AR would be split. Well, that's just being greedy. 70-30 is already a very rich split. And then to go above that, if you're hitting a 20%, let's see, so do a 20% for their term period. What would that be? 20 times 5. So basically, they would have to hit a 2. So they said they're going to hit a 1.9 equity multiple. And they're saying if they hit a 2 equity multiple, anything above the 2 is split 50-50. That's just greedy. I wouldn't recommend deals with that kind of structure. 70-30 is already pretty rich. They're going to have a hard enough time. So I've underwritten deals. Our model, we do 80-20, sometimes 75-25, depending on the deal, how rich it is. But more often, and that's for big value adds. More often on your average deal, which I would say this one's rather average, $130 rent increase isn't nothing crazy. Just from doing, underwriting hundreds and probably over 1,000 deals now, they're probably most likely that structure should be closer to an 80-20 if they're doing a full catch-up, which I believe they are. Because I just don't know how you're mathematically even going to hit even a 1.9 equity multiple. I haven't seen any numbers yet. So we're on page 40 now, still no pro forma or anything. So we're almost 80% through the package. Again, tell me what projected returns will be if I invested $100K. I think I can calculate that myself. You got a lot of fluff in these packages these days. Looks pretty fluff, but nonetheless fluff. The thing is 1031 eligible. Well, every deal is 1031 eligible. Again, fluff. Here we go, page 44. So now you're good and worn out. They finally show you some numbers. So you got trailing 12. I'm going to, let's see. First, let me get a second look at this. So a couple of red flags already. I'm going to erase this. We can go backwards if you need to. So when you're doing an accrual-based multifamily investment, sorry, when you're doing accrual accounting, which is basically everybody's doing it accrual-based, on your multifamily projections and pro forma, you got a couple of terms on the top line on the income side that have to be there. So first, let me show you what I'm looking at now. So now I have a gross potential. I've got an economic vacancy. So I should say vacancy or economic vacancy. Got a RUBS. So you've got this, it's going to be minus that. You got plus RUBS. RUBS is ratio to utility billing. Then you got plus other. So what they've done, typically there's a couple other items here. You've got, typically you're going to have a loss to lease. You're going to have standard vacancy, which is your physical vacancy. I'm going to tell you, at least I'm going to tell you what I think they're doing here. You're going to have concessions, and you're going to have bad debt. So loss to lease is going to be the difference between your lease. So say you got, so for example, in this property, for example, let's just use $200. They said in the beginning, increase 200, it's good for easy math. So their average rent was $1,000. And now they're going to do their rehab, and they're going to increase it $200. Their new average is going to be, this is mostly just for example, it's not exactly correct, but I'm trying to demonstrate what loss to lease is. So their average was about 1,000, they're increasing it 200. So their new average over time, once everybody is at the new lease, is going to be 1,200. But the key component there is time. Just because you increase the rent doesn't mean that everybody else's rent increases. You have to wait for their lease to expire. Then and then you can renew them at the new rate. But the reality is, you never renew anybody at full rent premium. Usually, you get up to like 80% of where they're at if they're not going into the unit. Let me back that up. Depending on what you're doing, if you're able to do the update with them in the unit, which sometimes, yes, you actually can do some things. Like if they were, for example, resurfacing, which they're not, but if you were resurfacing, you could actually resurface a counter while they're in the unit. You could change out their appliances while they're in the unit. You could put new fixtures while they're in the unit. So there are some things you can do while they're in the unit, and they stay and they get the new rent increase. And then even in that case, you would give them a discount. But in this scenario, in the perfect world, let's assume that every unit vacates, they do their renovation, and then they go to their new rent. You've got 12 months here that's going to take place over, because your standard lease is 12 months. So your average rent is only going to increase. It's going to increase from 1,000 to 1,200 over a 12-month period. And the delta between, but your GPR is going to stay at 1200 from here to here. So your actual average versus your GPR. And then the difference, that's your loss to lease, L to L, that's abbreviation. The difference in those two, that's your loss to lease. So you start off immediately out of the gate, you've got a $200 loss to lease, which is basically your rent premium. And then as you renew all the leases, then you get to a zero loss to lease, and then everybody is at the rent premium that you're leasing at. But that's also never true, because that next year, as soon as that happens, now you've increased. This is going to be probably, I don't know, say you increase it $50. So now you start the process again. You got more loss to lease. So it's just, it's a constant process. So anyway, I'm not seeing that here. I'm seeing gross potential. I'm seeing economic vacancy. So what they may have done with economic vacancy is they've buried all of this within that, which, again, I would want to see what that is, because it's very common for people to screw up the loss to lease item. And let me see. They're not showing me percentages either on here. So what they're showing me is straight dollar amounts. So what you need to do as a passive is to go in there and calculate what percentage it is. Let me see if they show another page here. Now they're giving me all the bio stuff. Yep, there's portfolio, track record, questions. Yep, this is it. You get one slide on numbers. Yeah, not very good. So you've got to manually calculate what their percent economic vacancy is. So it looks like we got 2377. Sorry, we're doing this live, so it might take a little bit. I'm just going to do 2 months, 2 years. You've got your T12, which if you see that, that means the trailing 12. And you've got year 1 and year 2. You're at 2, 3. Oh, sorry, let me put this, actually, 0. Well, that's dumb. Okay, so they showed RUBS, but it had 0 income all the way across, so why even show it? Other income was 70, 50, which, I'm pretty sure they talked about RUBS in the package somewhere, that they were going to implement that as a value add. We will also implement, okay, well, that, I'm pretty sure it's not illegal to do that in other states. Pretty sure it's standard practice. So, okay, well, maybe they just left a buttload of money on the table, because RUBS can be 10% of your income. It could be a big chunk. And for them to show 0 RUBS all the way across, again, that would be a red flag for me. 70.71. So, take the calculator out. Or actually, no, they've got total income 2.1. So that should be 2.1. Does that look about right? Plus, I don't know. That would be embarrassing if they did this math. 2.3, 2.377 plus 7 minus, oh, wait, no, 0.7 minus 346. Yep, that's right. This is 0 here. Okay, so that is correct. Now let's just do what percentages that is. So we got 1.35 over 2.37 7. Oof, that's a big number. So we are at 15%. And honestly, that's the one I'm most worried about because, well, let's see their other income. Well, let's just do it anyway. 0.070 divided by 2.37. It's going to be 0.3%. Okay, that's about normal. Now let's look at here. Look at their expenses. I'm just going to go straight to the bottom. And you see the growth. So it looks like they're going 650, 660, 704, 724. What I like to look at is taxes. One of the biggest. So here it is. One of the biggest items people miss most is taxes, underestimating what their tax increase will be. Because it really screws up your project. So you don't, nobody likes to estimate. Well, I don't want to say nobody likes to, but it's easy to use just kind of rule of thumb or just to assume like a 5 or 7% rent increase on taxes. That's what we do on an initial first pass of what the taxes are. But then once we've kind of gone to a later stage of underwriting, we'll then go in to do a more accurate calculation of the taxes, looking at the tax rate, looking at what we're projecting in our pro forma as the value, and then taking, an offset of that to calculate property taxes per year. So to get, to have a direct correlation of what we're projecting as the value to what the taxes are versus just a simple, dumb kind of straight line rent increase. So their taxes go from 137 to 285, and then 303, 309. Okay, well, it's good. I'm not going to calculate that, but it looks like they did take a big increase day one, which is always nice to see. Insurance stayed flat. One of the things on insurance you got to check is, if you're buying it from, depending on who you're buying it from, some operators like us and others would have a master policy where all their properties are under one insurance, which gives them really low interest rates. So then if you're buying it from them and you don't have a similar master policy, you're paying market rate insurance, your insurance is going to go a good bit higher than what ours would be. So you just got to be aware of that and ask the question of, hey, what kind of insurance policy is going to be on here? Is it going under a master policy? Is the other person leaving a master policy? Because that could be a big, that could be a $30,000, $40,000 increase. Here they're $70,000, so it wouldn't be uncommon to see a market rate deal, assuming this was a master policy deal, market rate to increase, $20,000. Utilities staying relatively flat. That's nice. I mean, there's the only time utilities would have a whole lot of volatility is if they're increasing the occupancy. So again, they're saying they're at 15% occupancy. So if they're going up to, they're projecting to be at 90%, which they haven't shown me any occupancy charts to see what the projected occupancy would be for the life of the investment, other than we haven't manually calculated. But again, this has to be blended because that's what economic vacancy is. It factors in, well, I don't know if that's what they're doing here. Typically, the term that we would use is your effective rent, which would factor in your concessions and your bad debt, all those things. So I'm assuming that they're factoring all of this. They're just calling it economic vacancy because of the large number it is. But ideally, you would want that broken out, and I would request to see it broken out. So one, to make sure that the vacancy assumption, the true physical vacancy assumption is a normal number or a realistic number, and also that the loss to lease expectation was a realistic number, because you would expect the loss to lease to spike as high as 10% in year one, which we could actually calculate what their loss to lease would be. So let me show you how to do that real quick. So in year one, actually it'd be a bit hard, but we can at least take a first pass at it. We can kind of, we can do the average loss to lease. So if you know their GPR is 2371, I'm just going to do a dirty calculation on it. That's their GPR. I know they're increasing their rent by $200. Let's assume they said actually we do 136 because that was, won't go with the more conservative number because that was the smallest number I saw. They've said on the package so far, they've said 200, they said 250, they said 177, and they said 136. So I'm going to go with the smallest number just to give them the best treatment, times 12 months times 100. Crap, how many units did they say this was? Oh, I forget the unit count sometimes. Units. 1 second. Here it is, 194. Keep that up here. Times 194. So that's per year they're increasing this by $316,000. 0.32. That's your gain. And so I would expect to see. So this is what you're going to have so by December. So let's say if you bought it in January, by December, everybody, if you're going through the units and they all have 12-month leases, in an ideal world, you can get through all of them in 12 to 14 months. So 2.37 plus 2.69. So that's going to be in December, and we're starting out with here. And yeah, so anyway, this would be, all right, let me think about this for a second. For us, it's calculated because it happens over, ours is a little more advanced, so the formula will calculate it, and we also do a reduction for renewals versus turns. But on a simple, assuming everybody turns, then yeah, that'd be, pretty sure I did that right, that'd be 32. Please correct me if I'm wrong. 132, divide that by this number, because that's your new GPR, 2.69. So their loss to lease on the, it's actually going to be a little bit less than this, but on the conservative side, just so you get an idea of what you're looking at, it's 12%. So 12% of that 15% number should be just loss to lease. So right away, I can tell just by calculating that on this low rent they gave me, that this number, something's not right here. Because, well, I'm sorry. No, that's the current guys. Let me look at what they're showing here. Well, not much better. Let's see. So they're year one. Hold this number in your hand. We'll go to see what they've got. 2.7. And then vacancy of 0.375. That 375 divided by 2.57, again, 14.6%. So they're saying they're lost. I'm assuming that this is loss to lease. Vacancy, bad debt, and concessions. Those are all the items that were not included on their top line that should have been there. So typically your vacancy on a conservative deal, you want to keep it, well, on this deal, they already said themselves the first year is going to be rough. They're expecting a higher vacancy than normal. I would expect a vacancy of 15% of this deal. So I would expect all of that to be 100% vacancy. Then you've got your loss to lease, which is going to be another 12% here. And then you've got bad debt. Bad debt's typically at least on the first couple of years when you're doing a big value add like this, your bad debt is going to be 2 to 3%. And then your concessions can also be a bit higher because you've got to release those units, so you're offering them big discounts. So I'd also look at 2 to 3% when you're in a stabilizing a value add deal. So let's just go ahead and plug in what those numbers could be. So, and then I would assume this by itself at 15%. It could go lower. We're doing a deal that's in the 70s right now. We're doing a huge value add renovation, $37,000 per unit per door renovation. And so, yeah, we knew we were going to have big vacancies. But anyway, let's just see what this one comes out to. So at 15%, 2.57 times 0.386. Bad debt, and I'm just going based on kind of benchmarks. 2.57 times, let's do the smaller number, 2%. That's vacancy. Bad debt, 0.05. Let's do the same 2% for concessions, 0.05. And then loss to lease, let's use this number here, loss to lease, 0.32. So the number that we get then, 1 times 2 plus is 0.81 million. So you can see right away we're looking at almost $500,000 per year off, which their NOI is 1 point in year 1. Let me just jump down to the bottom. The NOI for the T12 was 1.15. And the NOI for the year 1 was 1.12. And then they missed 500. Well, let's just say they missed exactly 5, or estimated minus 0. This number here gives you 0.43 miss. So that's right out of the gate, top line on the income. They were over on the income, the income was about $430,000 too high. So if you just take that out of this number, that gets you 700 or so. Let's see, minus 0.43. Yeah, 0.69 is what it should have been. And so that's the issue you run into. You're investing, they don't show debt service, which is another issue. So they've gone straight to numbers that didn't show your debt. They told you what the debt would be. This deal does not look good. So they've given you terms on the debt. They didn't tell you what the debt would be. If I had more time, I could go and calculate what that debt would be and tell you. But let's just do based on benchmarks that it's typically 30% of the GPR. I think, well, yeah, let me see what that comes out to. On a, what's the loan amount here? $24 million purchase plus 1.3 million capex. So there's 27 all in, right? That was what we saw on the previous page. 27 all in, 75%. So $20 million loan. What property I have that has $20 million I want to say, yeah, you're looking at close to 70,000 a month. This is just from memory. This is not. So that, oh no, but that's with insurance and taxes. Sorry. Then it's actually, I think it's like 50. You could be looking at a $600,000 loan. I would double check this part again. I'm just going from memory. I could be completely wrong. But it gives you some order of magnitude of what the debt service. I would say it's going to be between no lower than 400,000 and 600,000, and you've got an NOI of 690. So you've got 200. Well, actually, no. I know what they said because they told me their claim was debt coverage ratio was 1 point something in year one. But again, that's based on their busted numbers. Average DSCR. 1 second. Well, I lost it. I don't know where it's at. Could have sworn I saw it somewhere. Oh, here it is. Year one DSCR is 1.18. So they're telling you it's going to be 1.18, but they're also telling you it's based on this NOI. So then let's just go based on this NOI of 1 point. Hold on, just real quick. So that comes out to a debt service. I hope this is wrong. I really do. Based on that debt coverage ratio that they told me, based on their NOI, which I'll just show you the math real quick, was you just take this number here, one, that's their NOI, over the 1.18, gives you basically 950 as their debt service. If you can see that. Took the NOI divided by debt coverage ratio, gives you their debt service, which came out to 950. If that's the case, and all of this is correct, then they're negative cash flowing for, well, at least the first year. But you know, and in the second year NOI is 1.6. 1.6. And then I would go through this same exercise. I would lower these percentages to do this year two. I would do probably 10% stabilized. I would do a 1%, 1 to 2% bad debt, 1 to 2% concession, and then loss to lease. I would put, you know, a lesser loss to lease, probably like 3%, just because 3% is going to be your normal rent growth. Typically, your loss to lease and your projected rent growth for the year is going to be very close to one another, almost exact. But you know, loss to lease should be a little bit less. So I would assume a normal rent growth in year two. So a loss to lease of 3% would be pretty standard. And then redo their year two numbers and see what you get. But I'm assuming, just do a quick math calculation. If I were to basically just cut all this in half, then I would be at, let me see. I can't help myself, sorry. They are now, let me erase some of this. You just go over here. Year 2 GPR is 2. I'll stop at year 2, and then you guys can go on for yourselves. 2.9. Economic vacancy is 305. So we're just going to stop here because this was where all the errors were last time. So let's see what that is. 3 divided by 2.9 gives you a 10%, basically 10% economic vacancy. So let's see if we're at loss to lease of 3%, vacancy of 8. Typically, I mean, you don't want to. You can go as high as or as low as 5% vacancy, but we try and keep it 8% average. It gives you 92% occupied, and it's pretty conservative. But especially because you're coming out of a value-add rehab, so it's not really accurate to assume that you're going to go from a big renovation to the next year being at 8% vacant the whole year. You're still going to have some carryover from the last year. So I think even this is being a bit aggressive. My ideal would be at 10%. Bad debt, let's see they get under control. Let's just do it at 1%. Let's do concession at 1. Yeah, I'm trying to be a bit aggressive here just to give them the benefit of the doubt. Maybe it's a supermarket. Plus 8 plus 1. So that gets you at 13%. So we're not so far off here. 2.9, 13%. So you're going to be at 0.3. So they are off by about $70,000 in year 2. But again, that's being aggressive. If you want it to be more, you could easily bump up one of these. Say 9. Actually, I would think this one would probably stay at 2. 15. So just by making that change, now you're at 435 minus, so it's 135. So you're short 135. So let's go ahead and do the NOI calculation real quick. Your debt service always stays the same, so we know you've got 950. Oh, actually, no, it'll go up, actually, because the thing with bridge loans is that your loan amount increases as you burn down the money. So in year 2, they're at a 1.6 average, what they're saying, and their NOI projected is 1.6. So let's do that calculation real quick. 1.6 divided by. Oh, that's a coincidence. The numbers are exactly the same. 1.6 and 2.06 is or 1.6 is and then let's see what that does. So it gives you debt service of 1. So you've got cash flow 600K minus 135 puts you at 4. What is that? $465. Again, rough calculations. You got to assume, make some assumptions in here. But the most common error I see is on income, getting these loss to leases wrong, and also on expenses, either screwing up the taxes. I think I didn't do too deep a dive in their taxes, but I think it looks, at least they took a big hit. They increased them a good bit, which is nice. And everything else. Their management fee seems lower than the previous guy. Hold on. Payroll, that's a big scare. So their payroll number goes from the T12 of 308 to, which again, I always go back to a cost per unit because that's how you benchmark these things. Over 100, so 308 over 194 a unit gets you at 1.5, or I say 15, basically 1,600 per unit, which that is actually high. 242 divided by 194. 242 is their projection, and it gets it down to 1247, which is on the lower side. Actually, I mean, it's not too low. So I think these guys probably did have too expensive of a staff, which I didn't see them really talk about too much in here. They really talk mostly about the market, but yeah, their staff number would drop, but it wouldn't be an immediate drop either. You're not going to go from a payroll number of 308 to 242 overnight. There should have been some sort of transition there, but nonetheless, it actually does seem a bit fair. So, but you should at least ask the question, what's going on? Everything else seemed okay, but I would be worried for these guys because we just showed a net cash flow of 465. You've got a total investment of what did they say the total equity raise was? Give me 1 second. Total equity raise basically $7 million. So you got $7 million as your total equity, and you're making. They've got net cash flows in this year's negative. So year 2 should be negative, but yet they showed 8% in year one would be negative, but they showed 8%. So they go from negative to, so they're saying they're going to distribute 560 in year 1. They're saying they're going to distribute 560, and I'm saying it's going to be negative. What is that? 250. And then they're saying the same 560 in year 2, and I'm showing 465. That's where there. So again, you got to do your homework, passives. You can't just depend on what these guys are showing you. You got to know a little bit about the industry that you're investing in before just jumping all in. Because this package is beautiful. I mean, I'm not gonna lie. If I didn't know what I was doing, if I didn't know the industry that well, I would certainly invest because it has a lot of pretty pictures and nice infographics, and it hits a lot of the buzzwords. But at the end of the day, it just seems like a good investment to me. So anyway, I hope that was helpful for you guys. If you have any questions, feel free to reach out. And yeah, until next time, if you have any other deals you may look at, go ahead and send them to me, and I'll give you my opinion. All right, guys, take care. Have a good week, or have a good weekend.